Hello everyone, today is the 6th of May 2026 and in my new daily episode, I'm going to talk about on why, while stock investors are so euphoric, bond investors are instead freaking out. In the first part, I'm going to focus on and bring the attention to the huge discrepancy between what government bond yields are signaling compared to the volatility measures mostly used by traders to gauge the risk in the market. In the second part, I'm going to focus on the triggers lying on plain sight in the government bond space that can potentially blast at any time and start that chain reaction that will inevitably impact financial markets. Before we begin, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates.
Something very interesting has been happening for the past several weeks. While stock traders and investors' sentiment is beyond euphoric, bond traders and investors are freaking out. Please take a look at this chart that includes the 10-year government bond yields of major countries and the VIX. The first remarkable things we can observe is how, while both the VIX and yields spiked when the conflict in the Middle East started, the first then came back down to a normal level. But the second didn't, and overall continued to rise. The second remarkable thing is that, despite a war being an objective risk-off event, this time markets behaved in the complete opposite way, with risk-on assets like stocks so far significantly outperforming safer government bonds or precious metals like gold and silver. This is a matter I already analyzed in Oil Will Decide When Gold and Silver Bottomed, and gold and silver are facing their worst enemy, a liquidity crisis. So, no need to expand this topic further today. The last remarkable thing can be observed in the second chart here, where we compare the VIX, a measure of risk in stocks, and the MOVE index, a measure of risk in government bonds. As you can see, both are moving in tandem, and contrary to yields, the MOVE index followed the VIX closely instead. I believe some of you might now be willing to say, hey, if the MOVE index came down a lot too, that means bond investors aren't freaking out at all. Well, not so fast. Since the US Treasury's buyback program was launched in 2023 by Janet Yellen, the ultimate goal was to force a hard cap on US Treasury yields. As a consequence, from a trading perspective, since then, it has been a very profitable trade to short government bond volatility, because the artificial cap on yields so far assured volatility couldn't explode, and any temporary rise, like the one at the start of the war in the Middle East, was just another opportunity to exploit. Then, why are bond investors freaking out? Because, unlike traders who exploit quick moves in the market and can arbitrage volatility, fixed income investors who tend to buy and hold until maturity are having a hard time making money in a market currently in a downturn for 69 consecutive months, the longest slump ever recorded. Furthermore, everyone is aware that not only can volatility not be suppressed forever without consequences on markets and the real economy, and there's a big lesson from Japan here, but bond investors cannot afford to ignore rising geopolitical tensions and the rising problems in the credit space, especially private credit, as I recently discussed again in Private Credit Implosion, Trigger Greater Financial Crisis. The whole fixed income and FX space is literally a disaster waiting to happen. And there have not been so many triggers close to igniting the blast at the same time. Japan, where runaway inflation is pushing JGB yields higher and higher, but the Bank of Japan is still forced to keep interest rates artificially low and continue printing money, ultimately impacting the Japanese yen that can only be kept under control via FX market interventions. The US, where expanding government deficit that requires more and more debt financing to remain sustainable, is a problem in everyone's mind. The last trigger, the UK, where yesterday government bond yields hit a 1998 peak, a level already beyond the one that triggered the pension funds and insurance companies' crisis in 2022, and is now threatening to bust another government that is failing to manage the problem. What we are seeing is a big disconnect. Stock markets look calm and confident, while government bonds are quietly sending a warning signal. Rising bond yields mean governments have to pay more to borrow. And that matters because borrowing costs flow through the entire economy. Mortgages, business loans, and eventually jobs and growth. At the same time, measures of bond market stress may look contained on the surface because a lot of trading has been built around the idea that policymakers can keep yields from moving too far for too long. But caps and interventions don't remove the underlying problem. They mostly delay it, and when reality pushes hard enough, the adjustment tends to be sudden rather than smooth. The core message I have for you today is simple. Bonds are pricing in a world where risks are rising. Geopolitics, inflation uncertainty, heavy government borrowing, and cracks in credit. Even if stocks are still parting. If yields keep climbing, something eventually has to give. Either inflation cools and growth slows, policy becomes more supportive, or markets reprice risk-on assets to reflect tighter financial conditions. So, whether you're a trader or a long-term investor, this is not the time to assume low volatility equals low risk. It's the opposite. When the bond markets start flashing orange while equities stay euphoric, it often means that the real stress is building in the background, and the next move can be driven by forces most people aren't watching yet. Thanks a lot for listening to my podcast today, for supporting me on X, on Instagram, and for reading my research on JustDario.com. I wish everyone a nice day.